Brad Williams, Frugal Finance. Let's talk a little bit about asset allocation. What is asset allocation? In short, if you have a pot of money, you want to just put it in one asset, or do you want to diversify? In other words, you're going to put a little bit of money over in bonds, and then you're going to put a little bit of money in cash, and then you're going to put a little money in stock. Maybe you're young and you understand this crypto stuff, maybe real estate, maybe a combination of 3 or 4 or 5 different asset classes. Well, according to the SEC, asset allocation is dividing your investments among different assets, such as stocks, bonds, and cash. The asset allocation decision is a personal one. Allocation that works best for you changes at different times in your life, depending on how long you have to invest in your ability to tolerate risk. That's the key thing. Knowledge and risk. And if you don't understand risk, check out my playlist. I have videos pretty much covering the A to Z of investing. We're going to have something on risk. If you're a numbers person, I'll include the finance side of Frugal Finance. And it's rather quantitative, but it's a good starting point. There's going to be a couple hundred different videos strictly on the finance part. It's beginners to advanced. You can just weed through the information. If you see something that may spark an interest, check it out. Factors to consider, including your time horizon. Your time horizon, the number of years or decades you need to invest to achieve a financial goal. I don't say months. Why? Because I played that game, trying to make money short term. Well, yeah, I've been doing this for nearly 50 years. And if you're a short-term investor, well, you're just speculating. And I gave up speculating long ago. I made a lot of money. I lost a lot of money. I'm even in that regards. But if I were to start over again at 20, I would look at this years and decades and understand that powerful thing called compounding. If you understand compounding, you're going to be 99% ahead of the game, because that's the key to riches. Now, a few of you are going to get lucky and you're going to hit it big, and it's like winning the lottery. There's a few winners and a lot of losers. Good for you. You're smart enough. You figured it out. You made a lot of money. But then there's the average person who doesn't understand this stuff. Well, if that's the case, look at the decades kind of deal, long term. Now, risk tolerance. Risk tolerance is your ability and willingness to lose some or all of your original investments in exchange for potential greater returns. It's called risk reward. So there's this endless analysis on trying to figure out this risk factor and then your diversification factor. And mathematically, you can get about 90% of the way there. It's that 10%. It's called the black swan, if you really want to get into it. It's that unknown. And that unknown is that variable where there's not a professional out there that can tame that wild beast. It's the uncertainty. And that's where you are in terms of an investor. Hence, we see this roller coaster ride in the stock market. It goes up, it goes down. It goes up, it goes down. It goes up, it goes down. But you're going to notice it goes up, but it doesn't go down as far as the previous low. And it continues to do that until there's some crazy crisis, COVID, 2008, 2009, or 2007, 2008, mortgage meltdown. Then there was the Black Monday back in 87. You're going to see, historically, there was always 5 to 6 to 7 year upcycle and then a 2-year down cycle. That has changed. And a lot of it has to do with technology and a limited number of good publicly traded companies and a lot more money playing a limited game. So hence, we're seeing this bull run after COVID that is just amazing. I mean, it's just crazy. But is it realistic? Well, I'm not here to make any type of predictions. The market is what the market is. Hence, diversification. The practice of spreading money around the different investments to reduce risk is known as diversification. There's that old saying, don't put all your eggs in one basket. Some players do, and some players don't last very long, okay? There's that kid, well, he's not a kid, but 4 years ago, and the name escapes me, but he was playing a huge leverage position, and he was manipulating, well, he wasn't manipulating, the likes of Goldman Sachs and I think JP Morgan were providing swaps And this guy was buying the market. In other words, he controlled 3 or 4 stocks. In other words, he had all his eggs he had 4 eggs in his basket, and he was manipulating. In other words, he had control. So he was using his own cash to push the market higher, and then the next fool came in and kept pushing it higher, and then he pushed it a little bit higher. He was doing this, he was manipulating it because of the likes of Goldman Sachs and JP Morgan or whoever it was. They don't have to disclose that information. If you own more than 5% of a particular company, you need to report it to the SEC. And this guy was working around that particular issue, and subsequently, he screwed up. And he lost $23 billion in one day, and subsequently is now in jail. Why? Because he's manipulating it. But the point is, he was trying to manipulate the market using the lack of diversification. The general thumb, and mathematically you can do this for stocks, is 14 to 16 stock will provide you a pretty good diversification in terms of your risk, of sharing risk across the good stocks and the bad stocks. In other words, you may have oil, you may have retail, you may have technology, you may have medical and pharma. Let's say you have 5 different sectors. Well, let's say pharma and medical drop through the roof, but technology and oil go the opposite direction. Okay, it's called correlation. And when one goes down, perhaps the others are going to go up. That's why you diversify. One way to diversify is to allocate your investments among different kinds of assets. Historically, stocks, bonds, and cash have not moved up and down at the same time. Factors that may cause one asset class to perform poorly may improve returns for another class. All right, so there's multiple ways of diversification. You have a class diversification, and then you have an asset classification. All right, a class, I meant the stocks is one class, bonds would be another class, cash would be another, real estate would be another. 25 years ago, there was a reverse correlation between real estate and stocks. Today, they move hand in hand. Pretty much everything now, because it's global, everything is global. So what happens in China can affect the US. In the past, there was a wall. Now, if there's something in Europe, it could translate and affect the US and the world. So we're looking at a global economy, and diversification key to long-term success. I know, everyone uses this particular name. Look at Warren Buffett. How many different stocks does he have? Well, he's more than well diversified. Berkshire Hathaway is probably 40 plus stocks. So that's a well diversified portfolio. But he loads up only on 5 or 6 stocks, big time. For example, he owned a lot of Bank of America. Well, why? Because he bailed out Bank of America during the 2008 crisis. He bought a lot of Apple, and now he's selling some of that stuff, but he'll take huge positions in a handful of stocks, and then he'll have other positions in his other 30 some odd stocks. Still diversified, but it's weighted. Keep that in mind. You'll also be better diversified if you spread your investments within each class. Some investors find it easier to diversify by owning mutual funds or ETFs. A mutual fund is a company that pools money from many investors and invests the money in stocks, bonds, and other financial products. Mutual funds or ETFs make it easier for investors to own a smaller portion of many investments. All right, the reason why ETFs are so popular these days is because there's minimal fees. In the past, mutual funds were charging an absolutely just enormous commissions. FYI, I used to be a stockbroker. I used to be registered with FINRA, and I didn't sell many mutual funds, but I know there were individuals in the office that I worked for, that was their bread and butter, and they were making 8% commission on some of these mutual funds. Who were they looking out for? Well, they're looking out for themselves. Period. That is the game. Sorry to say it, but that's the way it is. And that's why you have ETFs, mutual funds. Here it is, the middle of 2025, and what was it, Vanguard, beginning of the month, said we're lowering our fees on our mutual fund to an absolutely just blinding low number. And that's good. They have to stay competitive with ETFs. So you, as an investor, you need to be aware. You need to be aware of these fees. And if they're high, get out. You're going to see some of these ridiculous fees in the private equity market that are just egregious. And again, if you're one of these super wealthy and you want to play the arrogant game and you want to be married to one of these private equity groups where they're charging, well, your end return is about 3.5% a year, where the market return, on average, is about 12.5%. Why is the same fund only paying 3.5% to me in terms of return, where an ETF is going to give you 12.5% hypothetically? Because these private equity groups are greedy, period. They're just greedy. The bottom line here, you, as the investor, need to be aware of these fees and move away from these people, okay? What is rebalancing? Rebalancing is what investors do to bring their portfolio back to its original asset allocation mix. Again, there's mathematical models, and if I haven't posted it yet, just comment. Say, Williams, you said something about balancing. Where's the math? Well, one, I don't know if you really want to go down that road because it's a lot of statistics, but I'll try to make it available. Rebalancing is needed because over time, some investments will grow faster than others. For example, let's say you were 90% into technology. All right, AI has gone through the roof. Well, how much more growth is there in AI? And then you think that some other sector is going to just skyrocket. Quantum computing. That's the hype these days. So the analysts are pushing, buy quantum. No, that's ridiculous. But you could take a sliver of your money and put part of that into speculation. In other words, you could buy, some of these startup companies. I wouldn't put much money in them. If you remember acorns, all right, or what is that? What it was? Acorn? No, it wasn't acorns. It was the these hyped up startups that unicorn. Yeah, you remember the unicorn hype back in 2022, 23? Well, guess what? How many are still around? I was reading yesterday that 95% of them are barely making it. So don't follow the hype of Wall Street. Don't jump into these IPOs unless you're well connected to one of the big banks that they have great relationships with some big time investors who get preference. Hey, it's the way it works. Rebalancing is moving out of one particular class or one particular type of stock, and maybe you think that the market's going to go upside down. New administration we have in place, I don't know. I am a little cautious. The reason being, nothing comes for free. So my argument is, okay, great. And this is the same Republican playbook. They've tried this again and again. It goes back to Reagan. It goes back to Bush. It goes back to Bush. It goes to Trump. All right, they want to cut taxes. But like any other company, the U.S. government isn't any different. You need growth. You need growth. And the only way to get growth is CapEx. And if you cut CapEx, cut growth. Subsequently, what happened? Well, good. Hypothetically, you say, well, we're going to cut federal spending. We're going to lower taxes. Okay, that's all puffery. But in the end, it doesn't work. You can read your own research. You can do your own analysis. And in 4 years, I'm just curious if, because we're going to have this huge inflationary component, prices are going to skyrocket. Now, if your wages match this inflation, big deal. But look at how many people are retired, okay? Their income is going to be flat. All right, so what if the cost of living is only 3%? Hypothetically, it could be, on paper, it could be 3%, and it will be manipulated down. But the true reality is inflation is going to be 8 to 9%. My experience says be very cautious. Be very cautious when somebody starts cutting and then expects great results by fewer employees required to do more work, especially in the public sector. It doesn't work, Mr. Elon Musk. It just doesn't work. So those are my 2 cents worth. There are 3 ways you can rebalance your portfolio. You can sell investments where your holdings are overweighted and use the proceeds to buy investments for underweighted asset categories. I do a lot of valuation. I won't get too much into valuation in my videos. Why? Because it is really complex. I might go on the skirts. But if you want to learn anything about valuation, check out Demoterin, NYU professor. I mean, he's a miracle man. He provides more information for free I've been a student of his for almost 20 years, and the reason being is his generosity. If you want to know more about valuations, check out Demotoring. Before you rebalance your portfolio, you should consider whether the method of rebalancing you decide to use would entail transaction fees or tax consequences. Here's your big deal: is your tax consequences. Long-term or short-term gains? Okay, long-term gains, it is a consequence, but in the past it used to be significant. It's the short-term gains, the day traders, you may be looking at it as going, wow, we get taxed pretty heavily on this. But that's the consequence. That's the cost of doing business. Some financial experts advise rebalancing at regular intervals, such as every 6 or 12 months. Others recommend rebalancing when your holdings of an asset class increases or decreases more than a certain preset percentage. In either case, rebalancing tends to work best when done on a relatively infrequent basis. Shifting money away from an asset class when it is doing well in favor of an asset category that is doing poorly may not be easy, but it can be a wise move. Cutting back on current winners and adding more current losers, rebalancing forces you to buy low and sell high. That has always been the notion, is buy low, sell high. It's just knowing what's undervalued and what's overvalued. Comment, let me know. Brad Williams, Frugal Finance. Hope that helped. Thanks for watching. See you soon.